I drew a little provisional tax timeline to hopefully try and see where we are in the timeline. So with provisional tax, we need to remember we have our 3 payments. We have our first payment, which is 6 months into our year of assessment. We have our second payment, which is at the end of our year of assessment. And then we have what they call a voluntary payment or a top-up payment at 6 months or 7 months after our year end. It is 7 months if your year end is February. If your year end is anything else than February, then your top-up payment is also 6 months. Okay, so in this case, the year end is February, so the top-up payment would happen in September. Okay, but remember, with that top-up payment in September, there is a, let's get a different color. There is a first payment for your new financial year that happens in August of your 2020 year. Okay, so just don't forget that when you're considering it as well. Okay, what assessment do we use? Because for this first payment, we obviously don't know what our taxable income is going to be at the end of the year. So SARS has given us kind of a formula. SARS says, well, you can choose. You can either use the basic amount or you can estimate your taxable income for the year. An estimate of taxable income should include any capital gains that have been incurred. This basic amount is based on a previous year of assessment. Okay, so the basic amount is your most recent assessment. So ideally, obviously, you would want your 2019 assessment, okay? But that's not always the case. It's not always the case that you've submitted your 2019 assessment because, look, when's your top-up, okay? September. So it's not always the case that you would have your 2019 year of assessment ready for your first payment for 2020. So what do? Well, then we go and we look at the previous year of assessment. So that would be my 2018 assessment. Now, provided I have my 2018 assessment and I have it before the 17th of August 2019, I will use whatever amount is in that assessment. So let's say the assessment was for 200,000. Okay, that 200,000 as my assessment amount, provided there are no capital gains or lump sums in there, I will use that as my basic amount for my 2020 year of assessment for my first payment. I don't need to do anything. I don't need to adjust that basic amount. I can literally just use the 200,000, okay? Work out the tax on that and pay 50% of it because I am halfway through the year. If I do not have my 2018 assessment before the 17th of August, okay, so remember where it says you have to have received the assessment 14 days before your payment, okay, that's what we're talking about as in the 17th of August. Okay, so anything from the 17th of August, so any assessment received after the 17th of August, we would not be able to use that assessment as our basic amount. We would have to go to the previous years. So assuming we've received it. Now, assuming we haven't received 2018, but we've got 2017's. And 2017 said we had 150,000 taxable income in our assessment, okay? We can use the 2017 assessment, but we have to go and increase it by 8%, okay? So for every year. So if we're using 2017, we're going to have to go and add 1.08% plus 1.08% in order to use it as a basic amount, okay? So that's the basic principle of how you get to basic amount and which assessment you use. I would recommend draw yourself a little timeline if you see that we are telling you dates of when assessments are or aren't and what payment that you're making. So that is to work out the basic amount if you're going to use the basic amount. Now this first provisional tax payment is only subject to a late payment penalty. What does that mean? It means that if I was supposed to pay 10,000 Rand on the 31st of August as my first provisional tax payment, and I miss that payment deadline, okay, and I pay late, I am going to have to pay 11,000 Rand, okay, being the 10,000 plus the 10% penalty, okay. So that's a late payment penalty, but it is not subject to an underpayment penalty. So let's say you pay 10,000, but technically you should probably have paid 30,000, okay? It doesn't matter. There's no penalty on underpaying your first provisional tax payment. However, when you get to your second provisional tax payment, there is no mercy in terms of underpayment. If you underpay, and there are some rules about the underpayment which we'll have a look at, you will be subject to an underpayment penalty as well as a late penalty if you were late. Okay, so it could be subject to both. If you just underpay but you're on time, you obviously won't incur the late payment penalty. For the second provisional tax payment, we would use our estimated taxable income. So when you are preparing your provisional tax return for the end of your financial year, you should have a pretty good idea of what your taxable income is. Yes, it could be slightly out because you won't have had all the information and you have to make your payment on the last business day of February, okay? You can use a basic amount still, okay? But that is only if it is less than or equal to R1 million. So if the taxable income exceeds R1 million Rand, you cannot use basic amount. You have to use an estimate of taxable income. Whereas if the taxable income or the basic amount is expected to be less than R1 million, then you may use the basic amount, which would be based on the same principles as what we did for the first provisional tax payment. Okay. If that second payment is late, 10% penalty, okay, on top of your tax. So that penalty is a once-off, okay? It's not like the interest that gets charged. So the minute it's late, it's going to incur interest, okay? That goes for all of your payments. But the minute it's late, it gets a one-time 10% penalty. Now, the second payment is subject to an underpayment penalty. So if you pay too little, okay, and this is what SARS wants to avoid. The reason for it is that by the end of the year, you should have a good estimate. You should be between 80 and 90% of what your taxable income is, and therefore you should have paid tax on that 80-90%, okay? Because what companies or provisional taxpayers could do is their first tax payment, they pay as little as possible, right? Because you want to keep the money in your own bank account and earn interest. Then your second payment, you also would love to make it as little as possible, okay? Then you would then pay your big payment as your third top-up payment where you then settle, okay? The impact for SARS is obviously a cash flow implication. They won't have much money throughout the year. They will only have it in essence 18 months later with your third top-up payment. So that's why SARS has in essence instituted the underpayment penalty, saying that, okay, if the second payment is far too little, so in other words, you got your estimate way wrong, okay, and you don't have good reason for it, then you're going to have to pay a penalty on top of that for underpaying because you're messing with the country's cash flow. That's my interpretation of why SARS would bring that in. Okay, so if we go have a look at what the principles are for this underpayment penalty. The underpayment penalty is only for that second provisional payment. Okay, so it only applies to the second payment, not the first, not the third. If your taxable income is more than R1 million, it has certain rules, and if it is less than R1 million, it has certain rules. So if you have more than R1 million, okay, so your second provisional tax payment is based on estimated taxable income. Then, if it is less than 80% of the final taxable income, so in other words, your actual taxable income, so if your estimate is less than 80% of your final taxable income, so that means if I have 10 million rand, okay, as my final taxable income, if when I was doing my estimate, I used 7 million, okay, then I am less than 80% of my final, and I will be subject to an underpayment penalty. Okay, so this is just to decide, am I subject to an underpayment penalty or not? Let's say my estimated taxable income was 9 million, my final taxable income was 10 million, then I'm fine. There's no underpayment penalty. That 10% difference, SARS is fine with, okay? Now, that's for if the taxable income exceeds 1 million. Where the taxable income is less than 1 million, if my estimated taxable income is less than 90% of that final taxable income and less than my basic amount, okay? So if my estimated taxable income is less than my basic amount and less than 90% of my final taxable income, I will be subject to an underpayment penalty. Okay, what does that mean? Let's say I had final taxable income of, let's make it 1 million exactly. Okay, so 1 million. If my estimate was sitting at, let's say, 800,000, and my basic amount was 850,000. Okay, that means my estimate is less than my basic, and my estimate is less than 90% of my final amount. It is 80% of my final amount. Then I'm going to be subject to an underpayment penalty. But now let's say my basic amount was 700,000. Then I will not be subject to an underpayment penalty because my basic amount was less than what my estimate was. Okay? Let's say my estimate, let me rather just change colors. Let's say my estimate was 950,000. My final taxable income was 1 million. Again, I will not be subject to an underpayment penalty because my estimate is not less than 90% of my final taxable income. Okay, so those are the principles that you need to work out to first determine, am I subject to an underpayment penalty, okay, or not? If I'm subject to an underpayment penalty, okay, I now again have two different ways of calculating it. If my taxable income exceeds 1 million rand, I'm going to go and take 20% of the difference between the normal tax on 80% of taxable income after rebates. Okay, now that's starting to sound confusing. Okay, and any employees or provisional tax that has been paid. So let's go back to our 10 million example. So we said our estimated taxable income here, we went with, let's say, 7 million when our final taxable income should have been 10 million. Therefore, we are sitting at 70% estimate, and we will be subject to an underpayment penalty. Now, when we're working out the actual penalty, okay, you need to change gears a bit. It says normal tax on 80%. Okay, so what does normal tax mean? Okay, my taxable income should have been 10 million. Normal tax on that would be 28%. So that's 2.8 million, right? But it says 80% of that. So 80% of that plus, okay, so 20% of the difference between and what I've already paid. Okay, the difference between those two, this is my difference. I'm going to multiply by 20%, and that's going to be the penalty. Okay. So that's what it is for where you have more than $1 million. Where you have less than $1 million, so let's go back to our it's where we had an estimated taxable income of, let's say, 700,000. Our final taxable income was $1 million, meaning again that we were sitting at 70%, so nowhere near the 90%. And let's say my basic amount was 800. Okay, so we are subject to an underpayment penalty. Now we're going to have a look at 20% of the difference between, and now we have the lesser of to throw it in. So first we need to go and decide the lesser of. Then we can go and deduct what we've already paid. So normal tax on 90% of taxable income after rebates. Okay, we're going to just assume it's a company to make it simple. So we've got our taxable income of $1 million, right? Normal tax on that would have been 28%, and they want 90% of that. And normal tax on the basic amount. So normal tax on this basic amount, okay, not times 25, not times 90%. So if we had 800,000 times 28%, so we need to, from these two, decide which is the lesser. And the employee's tax or provisional tax I've already paid. Okay, so this would be payment 1 and payment 2 together. So let's say it is, I paid 200,000 in those two payments. That difference is going to be subject to a 20% penalty. So that's going to give me, 20% will be a 4,000 penalty. Okay, so I still owe that additional amount, but I can top that up in my top-up payment, but I am going to have a penalty that I'm going to have to pay on top of what I would have had to pay anyway.